The number one reason most people never buy a home is a myth. They believe they need 20% down. They do the math on a $300,000 home, see a $60,000 number, and quietly give up. But that 20% rule is outdated, misunderstood, and frankly, has been keeping millions of people out of homes they could have already been living in. In this video, we are going to break down exactly how to buy your first home in 2026 with $10,000 or less out of pocket. Not a gimmick, not a loophole. Just a plain English breakdown of the programs, loan types, and strategies that already exist and that most first-time buyers never hear about until it is too late. Here is what we are covering today. Why the 20% down myth is costing you money every month you keep renting. The 4 loan types that let you buy with little to nothing down. Down payment assistance programs that can hand you free money toward your purchase. The strategies that stack these tools together to get your total out-of-pocket cost below $10,000, and the exact steps to take this week to start the process. Let us start by destroying the 20% myth once and for all. The 20% myth. The idea that you need 20% down to buy a home comes from the fact that putting down less than 20% on a conventional loan triggers private mortgage insurance. PMI is an extra monthly fee that protects the lender in case you default. That fee typically runs 0.5 to 1.5% of the loan amount per year. On a $300,000 loan, that is $125 to $375 per month. People hear about PMI and assume the only way to avoid it is to wait and save 20%. But here is what nobody tells you. There are entire government-backed loan programs specifically designed to help you buy with 3.5% down, 3% down, and in some cases, 0% down. And there are assistance programs that can cover that remaining down payment for you. While you are saving toward that imaginary 20%, you are paying rent. Rent that builds zero equity, zero ownership, and zero net worth for you. The math almost always favors buying sooner with a smaller down payment over renting longer to save a larger one. Loan type number 1, the FHA loan. The Federal Housing Administration loan is the most popular first-time buyer loan in America. Over 498,000 first-time buyers used an FHA loan in fiscal year 2024 alone. Here is why. The minimum down payment on an FHA loan is just 3.5% if your credit score is 580 or higher. On a $270,000 home, that is a down payment of just $9,450. On a $250,000 home, that drops to $8,750. If your credit score is between 500 and 579, the minimum down payment rises to 10%. That is still significantly less than 20%. The other FHA requirements are straightforward. A debt-to-income ratio of 43% or lower. Proof of steady income. The home must be your primary residence, and you must move in within 60 days of closing. The one downside of FHA loans is mortgage insurance. FHA requires both an upfront mortgage insurance premium of 1.75% of the loan amount and an annual premium of 0.55 to 0.85%. On a $300,000 loan, the upfront premium is $5,250, which is typically rolled into the loan rather than paid at closing. The annual premium runs about $137 to $213 per month. Unlike PMI on conventional loans, FHA mortgage insurance typically stays for the life of the loan unless you refinance into a conventional loan once you have 20% equity. For most first-time buyers with limited savings or credit scores in the 580 to 680 range, FHA is still the fastest and most accessible path to homeownership available. Loan type number 2. The conventional 3% down loan. Fannie Mae and Freddie Mac both offer conventional loan programs with as little as 3% down. The Fannie Mae Home Ready program and the Freddie Mac Home Possible program are specifically designed for low to moderate income first-time buyers. On a $300,000 home, 3% down is just $9,000. Here is the key advantage over FHA. Private mortgage insurance on a conventional loan can be removed once you reach 20% equity in your home. That means as your home value rises and you pay down your balance, PMI eventually disappears. FHA mortgage insurance typically does not disappear without refinancing. For buyers with credit scores of 620 or higher, a conventional 3% down loan is often more cost-effective than FHA over the life of the loan. The eligibility requirements for Home Ready and Home Possible include income limits based on your area median income, completion of a homebuyer education course, and the property must be your primary residence. Loan type number 3, the VA loan. If you are an eligible veteran, active duty service member, or surviving spouse, the VA loan is the single best mortgage product available in the United States. Zero down payment required. No private mortgage insurance. Competitive interest rates often below conventional loan rates. No minimum credit score set by the VA, though individual lenders typically require 580 to 620. The only fee is a one-time VA funding fee, which ranges from 1.25 to 3.3% of the loan amount, depending on your service history and down payment. This fee can be rolled into the loan, so your out-of-pocket cost at closing can be dramatically reduced. On a $300,000 home, a qualified veteran could potentially close with just a few $1,000s in closing costs and zero down payment. If you have served or are currently serving, use this benefit. It exists specifically for you. Loan type number 4, the USDA loan. The United States Department of Agriculture loan is the most overlooked zero down payment mortgage in America. Zero down payment required, below market interest rates, available to buyers in eligible rural and suburban areas. And the definition of rural is broader than most people expect. Many suburban communities outside major cities qualify for USDA loans. Income limits apply and are set at 115% of the area median income. The upfront guarantee fee is 1% of the loan amount, which can be rolled into the loan. The annual fee is 0.35% of the remaining loan balance per year, which is significantly lower than FHA mortgage insurance. To check if a property qualifies, go to the USDA eligibility map at eligibility.sc.egov.usda.gov and enter the address. Millions of properties that buyers would never think of as rural qualify for this program. Putting it together, how to get below $10,000 out of pocket. Here is where the real strategy comes in. The loan programs we just covered reduce your down payment to 3.5% or less. But closing costs are a separate expense that catches most first-time buyers off guard. Closing costs typically run 2 to 5% of the loan amount. On a $270,000 loan, that is $5,400 to $13,500 in addition to your down payment. So how do you get your total out-of-pocket cost below $10,000? You stack the available tools. Tool number 1, Down Payment Assistance Programs. Down Payment Assistance Programs, known as DPA programs, exist in every single state in the country. These programs are offered by state housing finance agencies, local governments, and nonprofits. They come in 3 forms: grants, which are free money that never has to be repaid; forgivable loans, which are technically loans but are completely forgiven if you stay in the home for a required period, usually 3 to 10 years; and deferred payment loans, which do not require repayment until you sell, refinance, or move out. The amounts vary by program and location, but commonly range from $3,000 to $15,000 and sometimes higher. For example, Indiana's First Place program offers up to 6% of the purchase price for first-time buyers. On a $250,000 home, that is $15,000 in assistance, enough to cover the entire FHA down payment and contribute to closing costs. California's My Home Assistance Program offers a deferred payment junior loan of up to 3.5% of the purchase price for FHA buyers. New York City's Home First program offers up to $100,000 in down payment assistance for qualifying buyers in the 5 boroughs. To find what is available in your area, search your state name followed by housing finance agency and look for first-time homebuyer programs. Every state has one. Tool number 2, seller concessions. A seller concession is when the seller of a home agrees to cover some or all of your closing costs as part of the negotiation. This is extremely common in buyer-friendly markets and on homes that have been sitting on the market for a while. FHA loans allow seller concessions of up to 6% of the purchase price. Conventional loans allow up to 3% with less than 10% down. On a $270,000 home, a 3% seller concession covers $8,100 of closing costs. That alone can dramatically reduce or eliminate your out-of-pocket closing cost expense. When your real estate agent submits an offer, you can ask them to request seller concessions as part of the deal. In exchange, you may offer slightly closer to asking price, which is often still a better financial outcome than paying thousands in closing costs out of your own pocket. Tool number 3, lender credits. Similar to seller concessions, lender credits are when your mortgage lender covers some of your closing costs in exchange for a slightly higher interest rate. This trades a small long-term cost for a significant short-term savings on cash needed at closing. For buyers who are cash constrained and confident they will refinance within 5 to 7 years as rates change, this can be a smart trade-off. Tool number 4, gift funds. FHA loans allow you to use gift money from a family member, employer, union, or approved organization for your entire down payment. The donor simply needs to provide a gift letter confirming the money is not a loan and does not need to be repaid. This means if a family member can contribute even $5,000 to $8,000 toward your purchase, that combined with a DPA grant can get you into a home with very little of your own cash. The math on a real example. Let us run a real scenario. You find a home priced at $275,000. You use an FHA loan with a 580 credit score. Your required down payment at 3.5% is $9,625. Your state DPA program provides a forgivable grant covering 3.5% of the purchase price, which is $9,625. Your down payment out of pocket is now $0. Closing costs are estimated at $7,000. You negotiate a seller concession of $4,000. A family member gifts you $2,000. Your remaining closing cost out of pocket is $1,000. Total out of pocket to buy a $275,000 home, $1,000. This is not a hypothetical magic trick. This is a real combination of real programs that real buyers use every single month in this country. The difference between buyers who know this and buyers who do not is not income. It is information. Tool number 5, house hacking. One more strategy worth understanding is house hacking. House hacking means buying a multi-unit property, living in one unit, and renting out the others to cover your mortgage. FHA loans allow you to purchase properties with up to 4 units as long as you occupy one of them as your primary residence. This means you can buy a duplex, triplex, or 4-unit property with just 3.5% down. Your tenants then pay your mortgage through their rent. In many markets, a well-chosen multi-unit property generates enough rental income to cover the entire monthly mortgage payment, meaning you effectively live for free while building equity. The long-term wealth building potential of house hacking is extraordinary, and it starts with the same 3.5% FHA down payment we have been discussing, the step-by-step process to start this week. Now, let us make this actionable. Step 1. Check your credit score today. Your credit score determines which loan programs you qualify for and at what terms. If your score is above 620, you qualify for conventional loan programs. If it is above 580, you qualify for FHA loans with 3.5% down. If it is below 580, your priority is to raise it before applying. Use the credit improvement strategies we covered in last week's video to move your score into the 580+ range as efficiently as possible. Step 2. Research EPA programs in your state and city. Go to your state housing finance agency website and look for first-time homebuyer programs. Search HUD.gov for approved housing counseling agencies in your area. These counselors provide free advice and can tell you exactly which programs you qualify for based on your income, location, and credit profile. Step 3. Get pre-approved with at least 3 lenders. Pre-approval is not the same as pre-qualification. Pre-approval means the lender has reviewed your actual income documents, credit report, and assets, and has given you a conditional commitment for a loan amount. Sellers take pre-approved buyers seriously? Pre-qualified buyers often get ignored. Apply with at least 3 lenders to compare rates, fees, and program availability. Many lenders specialize in FHA and DPA programs and know local assistance options that others do not. Step 4. Complete a homebuyer education course. Most DPA programs and many loan programs require a homebuyer education course. These courses are typically available online through HUD-approved providers. They take 6 to 8 hours to complete and cost nothing or close to nothing. Completing this course before you need it puts you in a position to move fast when you find the right property. Step 5. Start working with a buyer's agent. In most states, buyer's agents are compensated by the seller, which means their services cost you nothing out of pocket. An experienced buyer's agent who knows first-time buyer programs in your market is one of the most valuable resources you can have. Tell every agent you speak to that you are using FHA financing or a DPA program. A good agent will know exactly how to write offers that work with these programs. The honest truth about timing. Some people will watch this video and say, "Now is not the right time to buy a home. Rates are too high. Prices are too high. I should wait." Here is the honest answer. Waiting to buy while renting is not a neutral decision. Every month you rent, you are paying someone else's mortgage with no equity, no appreciation, and no ownership to show for it. The buyers who consistently build wealth through real estate are not the ones who timed the market perfectly. They are the ones who got into the market as early as they reasonably could and let time and equity do the work. A home bought today at a higher rate can be refinanced when rates drop. A home not bought today cannot be bought at today's prices. That is the math that most renters never hear. Your action plan this week. Go to annualcreditreport.com and check your credit score. Search your state name plus housing finance agency and find the first-time buyer programs available to you. Apply for pre-approval with at least 1 FHA-approved lender this week. Even if you are 6 to 12 months from buying, starting the pre-approval process now tells you exactly where you stand and what you need to fix. If this video gave you something useful, hit subscribe. Every week on the Compound Brief, we break down money, careers, real estate, and business in plain English. No fluff, no gatekeeping. Next week, we are covering how to negotiate your salary, and the research shows that most people leave $5,000 to $10,000 on the table in every single negotiation simply because they do not know one thing. That video drops next week. See you then.